Death and taxes, the only two things certain in life. On the one hand, taxes help fund the social welfare programs for the community. But recently, we've been seeing a lot of articles and news where they talk about how people have been misappropriating and wasting that taxpayer dollars. So when you go in and year out and review your taxes, you want to make sure that you minimize the tax liability that you have to contribute to the social welfare programs, but make sure you keep more after-tax wealth and income for yourself. In this video, I want to talk a little bit about a certain tax investment strategy, specifically to real estate investment owners. It's a cost segregation analysis, and it's a powerful and potent tool that you could use to be able to manage cash flow, reduce taxes, and keep more after-tax wealth and income for yourself. So what is cost segregation analysis? It's a powerful tax strategy that allows real estate investment owners, especially in the beginning years, to accelerate depreciation and front load by depreciating the inside contents of the real estate, not only the outside contents and the bones of the structure. Usually when you depreciate a real estate investments, if it's residential, it's for 27 years. If it's commercial, I believe it's 39 years. So over time, what you're doing is that you're leaving money on the table by not implementing this cost segregation analysis study. By implementing this cost segregation analysis study, you're able to front load the inside contents of that real estate and split it up into 5, 10, and 15-year depreciation schedules, and also apply bonus depreciation. So now I want to talk a little bit about the applicable IRS statutes. It isn't something that is outside the parameters. It's within the parameters of the tax law, and it's permissible. This isn't an illegal tax evasion or tax loophole. So what are some of the IRC codes that govern this? It's 167 and 168. What is 167, you may ask? So this establishes the federal tax guidelines governing the depreciation deduction. It also allows taxpayers to recover the cost of certain property used in business or for income production through annual deductions reflecting exhaustion, wear and tear, and obsolescence. 168 establishes the accelerated cost recovery system and a modified accelerated cost recovery system used to calculate depreciation deductions for tangible property under the U.S. tax laws. So in this next slides, in the next couple slides, I wanted to go a little bit about the process, how you implement it, and then give a mathematical example to show the power of implementing this cost segregation analysis. So first, you structure on purchasing the property. Second, you conduct an engineering study and report so you could see what is the percentage of the inside contents that you could front load in years 1 through 5 to the front load and accelerate depreciation. And the rest will be depreciated either on 27.5 year schedule or 39, depending between whether it's real estate, residential, or commercial. After that, you're going to do asset reclassification, whether it's within a holding company that holds the real estate on that tax return or on your personal tax return. And fourth is to make sure you accelerate the depreciation and realize the benefits and the tax benefits, which is cash flow. So in this case study, we're going to take a 700,000 luxury home. With the total cost base of 700K, we can estimate that the land value is 100K. And we know, or we should know, that land value cannot be depreciated. It's infinite. So our remaining depreciable building value is 600K. If we divide that by 27.5 years, we could see here that the depreciation is only $21,818 per year. So if we go into example one, we're going with the depreciation schedule of taking the 600K remaining building value, dividing it by 27.5 years. That is a non-cash depreciation expense of $21,818 per year. And if we assume that this is for a taxpayer that's in the highest marginal tax bracket, which is 37%, we can see here that the tax savings per year is $8,072. So the tax savings from year 1 through 5 from this depreciation being applied is $40,360. Now let's look on the flip side. Now, if we do apply a cost segregation analysis, this is where the real power comes in. Assume an acceleration depreciation allocation of 5. Now, in this cost segregation analysis study, we're going to break up that 600,000 into multiple parts, into 5-year, 15-year, and 27.5-year to make it simple. We're going to assume that 13.5% of that 600,000 is going to be depreciated on 5 years. 31% of that 600,000 is going to be depreciated on 15 years. And the remaining 55.5% is going to be depreciated over 27.5 years. So essentially, just from bonus depreciation alone, which is 20% for this year, and it's higher for real estate placed in service before 2022 and until 2022, that bonus depreciation is going to be approximately $54,000. If we take the total year one depreciation, not just the bonus depreciation, but the other components that are being depreciated on 5, 10, and 15 years, or 5 and 15 years and 27.5 years, the total year one depreciation is 86,000 compared to 21,000. That's a multiple of close to 4 times, which is a non-cash expense that's going to dramatically reduce that taxable income compared to not implementing a cost segregation analysis. Now, what is that figure? If we take 86,000 and multiply, again, assuming that the taxpayer is in the highest marginal tax bracket of 37%, that tax saving is $31,853 for that year alone, in comparison to $8,072. Now, let's compare the tax savings in year 1 through 5 of implementing a CSA cost segregation analysis with not. In years 1 through 5, with not implementing a cost segregation analysis, you are generating a tax saving of $40,000. But with implementing a cost segregation analysis, this estimate that we have for this example, it's $85,600, which you see the magnitude. It's pretty much 112% increase by just implementing this cost segregation analysis. And this is a powerful tool that a lot of real estate owners have at their disposal. And another thing I wanted to add on top is that the date that it was placed in service is imperative. In 2022, you could deduct 100% in bonus depreciation, and sequentially every other year after that, it dropped by 20%. So 23, 80%, 24, 60% bonus depreciation, 25, 40%, and 2026 is 20%. So the remaining depreciable building value is 600K. If we divide that by 27.5 years, which is a permissible tenure that the IRS allows, that is $21,818 of depreciation expense that you could apply on your tax returns per year. If you assume that for that taxpayer, then the highest marginal tax bracket of 37%, we multiply 37% times that depreciation expense to estimate the tax savings that we will get per year for that real estate investment. And that number is $8,072. So from year 1 to 5, those total aggregate tax savings would be $40,360 without implementing a cost segregation analysis. Now, if you do, this is where I want to look into alternative number 2. And in this example, I showed that with implementing a cost segregation analysis, you get a 112% increase on your tax savings, which is material. So the numbers, real savings in the breakdown. So we saw that in years 1 through 5, the total depreciable expense that you'll have by implementing a cost segregation analysis is $231,302. And if you apply, assuming the highest marginal tax bracket of 37%, that equates to tax savings for years 1 through 5 of $85,582. A bona fide, when done properly, non-cash expense that will increase after-tax wealth and income as well as increase cash flow. So why smart investors choose cost segregation? Maximize your cash flow and minimize your tax burden. Turn depreciation into a powerful wealth building strategy for what you have going on. And if you thought this appeals to you and you want to learn a little bit more, please reach out to us. Up here is a little bit about our contact information. Thank you.